Next speaker on the program today is Troy Applehans. And Troy is a longtime friend. He is a cattle analyst that covers this part of the country for cow-calf and stocker programs, as well as some feed yards. Troy has got a wide history in the cattle industry, everywhere from animal health to breed associations to livestock publications, and with industry organizations and private companies. I am a fan of CattleFax. I use them daily and encourage you to be a member. Troy has been here to present market and weather outlooks for us for this program for several years. Troy, come on up, and I want each of you to consider being a member of CattleFax. It's easy to do, and it's great information to help make informed decisions in managing our ranches and managing risks. Please help me welcome Troy Applehans.
I tend to move around a lot, and I'm afraid I'll fall off of here if I stay up here, so I'll get down. Andy, I've known you a long time. I'm proud to call you my friend, and congratulations on another spectacular and terrific event that you've lined up. And more importantly, he does this for all of you, and that's a testament to Andy. I appreciate and I love his passion that he has, and we all know he certainly has a lot of that. I'm grateful to be here for all of you. We've got some exciting news to tell you. We've also know that there's challenges within this business. Those of you that were here last year will recall me saying that I thought I had probably the most exciting and I guess best presentation that I've ever been able to give here. I still feel that way. We all know the challenges that are out there with the rampant input costs, cost of gain, inflation, those types of things that are challenging to us. We know that cattle prices are going to be higher, but are we going to net more dollars? That's the challenge that we see going forward. I did want to show this in terms of the U.S. beef cattle cycle, because every 10 to 12 years, we tend to have a high to a high or a low to a low in the value of the cattle prices. We're in the initial stages of this market getting really, really good. We do feel like that we're going to be able to outpace inflation, that you are going to be able to net more dollars as a cattle producer going forward. We are in the initial stages of this where these cattle prices are just starting to turn. The futures market has led us that way. We continue to see this really weak basis pattern, meaning that we have these huge premiums within the futures markets. The market sees better times ahead for each and every one of us. We see this going into the middle of this decade, where cattle prices will begin to continue to peak out. We do feel like, I know those of you that are in the room that remember 2014 and the high prices that we saw during that time. We feel like we're going back there, probably will surpass those levels at some point going forward. I remember distinctly back during that time frame when I felt that bred female prices got too expensive. They put a lot of people out of business. $3,000 bred female prices in 2014 are different than bred female prices in the middle of this decade. I fully realize that in a drought and we have to buy those females back, that's a challenge. But hopefully we can stabilize this cow herd as we go forward. We've done that. If you look on this chart, we've had the total inventory is back to where it was similar to in the late 1950s, okay? Since that time frame, we've also been able to do more with less. Talk about sustainability. Sustainability to me, number one is this, but secondly, it's those generations of ranchers and farmers that are in this business, 2, 3, 4 generations. That's also a pretty sustainable business model, isn't it? 2.3 times the amount of beef production that we had in the late 1950s with the same number of total cattle. One additional way that we've been able to produce more is obviously through bigger carcass weights. We've seen an average of about 4 pounds per year increase in carcass weights. 2020, you can see how big that was. We just simply weren't able to get the cattle harvested in time. We all know that the pandemic slowdowns in the plants was really impacted. Those are things that are starting to remedy themselves. We're starting to get more packing capacity going forward as well. Let's talk about demand. Demand is something that, and you'll see this on this chart, from 1980 to the demand low in 1998, beef demand was cut in half. Quite frankly, we had an inferior product. During that time frame, in the early 80s, we had about 43% of the cattle that were grading choice. That's all. 1 in 3 eating experiences from consumers was not satisfactory. We lost demand, cut it in half, and since that time frame, we've grown it. It's been the best in over 30 years. Beef demand is the best it's been in over 30 years. And we look at that, since 1998, retail, wholesale, and fed cattle prices have outpaced inflation. We've got a much better product for the consumer, and that's what we needed to get in order to turn the demand situation around. When we can outpace inflation like this, and since 1998, we've seen an average of 2.14% inflation. It's certainly not the case today, is it? We'll show you that later. Highest quality product we've ever had. We've improved the prime production from 2.5% in 2005 to 10% last year. The top 2/3 choice, or CAB, if you will, from 14% to 24%. The quality and consistency, we've improved beef demand substantially, but we've got the best and highest quality product to offer to the consumer that we've ever had in our lifetime. That's a testament to you as cattle producers. It's a testament to the genetics that we've seen from your seed stock providers, those types of things, the animal technology that we've seen improve as well. When you get a higher quality product, consumers are willing to spend much more for it, aren't they? So when we look at this and we look at beef expenditure since 2000, it's more than doubled that of our competing proteins of the pork and poultry business. Over $81 billion since 2000, and 154% increase. We're able to take some market share away from the competition, and that's certainly what we need to do going forward, but we know that beef is also the most price sensitive because it's the most expensive as well. The market's working like it should. We all talk about we need more cash discovery, and I'm not here to be on either side of the fence. We do need cash discovery, but the market is also working. It's offering the premiums and the discounts. It's rewarding the higher quality cattle, and it's discounting the inferior cattle that hopefully we can continue to improve on. When we look at the markets, when 35 to 65% choice is basically a par price, when we look at the premiums by grade, those inferior cattle under 35% choice are getting discounted. And over the last several years, since 2012, all grades, we've probably averaged around $30 to $35 per head premium. So you wonder why people sell on grids and premiums, because they get more dollars for the cattle. And that's certainly a testament to those of you that are in the cow-calf business, that if you're willing to retain ownership and have some skin in the game, you can be rewarded for what you're providing in terms of your genetics. This is just the additional value of the grades. Just from prime to CAB, that spread is about $20. CAB to choice is about $20, and the choice select spread is about $20. This is the value, the record large wholesale grade premium for 2021. This is just the spread that we've seen in the marketplace. Those higher quality cattle that are getting rewarded for the grade that they have. The one thing we haven't had is leverage. You know, those of you that were here last year will probably remember me talking about leverage. And when we measure leverage, we look at it as a fed cattle price minus the drop credit or the hide and offal value as a percent of the composite cutout. Look at 2011 to 2015. We were averaging somewhere in the mid-50s to upper 50s in terms of leverage, seeing how much the cattle were garnering of the composite cutout value over the packer, okay? Since then, 2016 is when the leverage shift really began. We continued to see more and more plants that weren't able to be profitable, that were idled, if you will. We've gotten a smaller percentage of the cutout piece every year since that time frame. That's starting to change. We're starting to see a shift. 2022, we're seeing that we're above 2021 levels. We feel like that we can average somewhere in the mid-40s this year. It's still not back to where we want to be, but we're going in the right direction in terms of leverage. And we all know that the Packers had significant advantage over the past several years, just simply due to the capacity situation, and we got an oversupply of cattle and not enough hooks to put them on. The thing that I want to show, and if you're going to remember one chart, remember this one from today, okay? Because from 1980 to the demand low in 1998, as I showed you earlier, we were all trying to split. I mean, you look at all four of these segments, we were all trying to split $32 per head. That's all the margin there was. That's not a sustainable business, folks, when you have to split $32 amongst four different segments of production. When demand began to increase, you could look at this as a per head value if you'd like, between those four segments. The one thing I did want to show is prior to 2016, on the previous chart when I showed you the leverage shift began, look how very little yellow you see prior to 2016. Look at the Packer profitability and how slim that was. Packers tried to make $30 a head. Well, if it was prior to 1998, $30 a head was about all there was, right? They couldn't do it. We've seen several packing plants that have been idled. The good thing is that we have this margin in the system. That's a tremendous thing to have. There's margin to get from somebody. Prior to that time frame, there wasn't any margin to get from any segment. We see a lot of yellow. We know the Packers making the most money. But at least there's margin to get, and as we gain leverage, as these numbers start to decline, and we start to have ample shackle space for the number of head that we are producing, the leverage shift will come back to you as a producer. We look at the per head value created by industry segment. This one has all those other segments, and this is simply the dollar value per head at that time frame. It doesn't have anything to do with margin. Just the dollar value generated per head by segment. When you include the retailer in here, and you look at the packing segment, and you see the packing segment and the end user, by end user I'm meaning retailer or those food service companies, that animal is $5,000 per head. $5,000 per head is generated by the end users in this country. So when we think about, and we cuss the Packers a lot, and we're mad at them because they're making all this money, and we see the divide there. We see where the green really started to increase back there in 2016, and they were getting a bigger piece of the pie. But also think about the retailer and the margin, or not necessarily the margin, but the dollar value that is being generated. We know everybody's expenses have gone up. This doesn't have anything to do with margin, but it does show you the value of an animal at each stage of production. I did want to show you, when we talk about the packing segment, think about this and when all these packing plants started to close and idle. We look at the slaughter, as it goes down, packing plants were having a hard time making any profit, weren't they? I'm going to go through these, but you know, since 2000, there's 1, 2, 3, 4, 5, 6, 7, 8 plants that have been closed. Seems like when Plainview closed, that was certainly something that impacted this part of the world. Doesn't seem like it was that long ago, but I guess it was. But as we're going down again, we are going to gain some packing capacity. The government has obviously committed some dollars towards packing capacity. We do feel like that we're going to have, by the end of this year, another 2,500 head per day capacity. By the end of the next several years, another 4,000 head. And we are going to increase efficiency. I think one of the big challenges that we've seen over the past several years is that you as a producer are looking at the packer and saying, well, those greedy packers, they're just not reinvesting in the industry. They're not reinvesting like I would as a cattle producer. In other words, when cattle feeders make a pretty good click on some cattle, they'll go back and pay more for feeder cattle. Feeder cattle producers will go pay more for calves. Cow-calf producers will pay more for bulls. We have that trickle-down effect in this business. And it seems like that when the packer has done this, they haven't reinvested in the industry like they should. I'm not here to back a packer. I think they have started to reinvest. We know that their expenses are much higher than they have been over the past several years in terms of labor, but they have also invested in robotics to look at more efficiencies within the packing plants. Now, granted, they've still been very, very profitable over the past several years, but they have reinvested it into the industry to a degree that I think is going to help us going forward. We will be able to utilize a higher percentage of the packing capacity. When this red line, the weekly average slaughter, is above the blue line represents a 40-hour work week, you know we're not going to have any leverage, because these packing plants are having to run hard on Monday through Fridays, and in addition to that, they're having to run on Saturdays. Well, most of the employees today don't want to work on Saturday. Doesn't matter what segment of production you're in. We've seen all these disruptions. 2019, the plant fire in August of 2019 in Garden City, Kansas. Obviously in 2020, the pandemic-related slowdowns in these plants. Early 2021, we also saw a significant weather event in February of that year and ongoing effects of the pandemic. And even in 2022, we've seen with the resurgence of the Omicron variant early this year. Just continues to see disruption after disruption after disruption. Seems like sabotaging this market. We're getting that back online. We're getting more fed cattle capacity, and we've got number of harvest levels coming down. We're going to gain leverage. You as cattle producers will gain leverage and be more profitable over the next several years. This is obviously a challenge. It's not a secret to anybody here, but I live in eastern Colorado and made the drive here yesterday, and it looks the same the whole way. There's not a very pretty green field out there anywhere until you start to see some wheat under pivot. When you get in the Panhandle of Texas, we know we're dealing with a situation that only God can solve. And we do our rain dance every day, and it's not working yet, but let's hope it does going forward. I want to show you this. This is our weather outlook, and this came out in early April. And on the left, we've got the temperatures for April and May, and on the right, we have the precipitation. When we see, particularly in the Texas Panhandle for the month of April and even May, it looks normal conditions, right? But we're starting off so dry. And you've got the warmer temperatures that certainly aren't helping it out. And I don't know, but the wind has been blowing in Colorado like nobody's business, and I'm sure it has here as well. The wind certainly doesn't help anything out. So when we get to a little longer term, it still doesn't look very good, folks. And I hate to be the bearer of bad news, but it is what it is. When you look at the temperatures, it's going to be warm for the summertime frame. Very warm. Looks like the best chance for precipitation, above average precipitation for this part of the world, is in the month of June. But hot and continued dry through the end of the summer is the outlook that we have today. I'm sure those of you that follow any weather forecasters hear about this El Nino weather pattern that we've been in for the bulk of the past 2 years. The cold sea surface temperatures on the equator that are stubborn. Been very stubborn. We have a weather forecaster that works for CattleFax, and he gives us weekly updates on this. And it's a stubborn pattern, but he says that going into the fall of this year, that he does expect the La Nina weather pattern to turn more neutral, if you will. Not necessarily going into an El Nino or wet weather pattern, but more normal conditions or a neutral weather pattern going forward. We can only hope and pray that that is the case going forward, because we really, really do need to stabilize the beef cow herd. This is a weighted average chart that we look at the number of cows. This is weighted based on the number of cows. So Texas with 4.5 million beef cows, this is weighted more heavily towards the state of Texas than it would be, say, Nevada, for instance. But there's 67 or 2/3 of the nation's cow herd that are in some form of drought. In some form of drought, it could include abnormally dry. But when you look at 52% that are certainly in a drought around the country, and when you look at the bottom, the dashed red line, we've only had 1 year, 2013, where we're coming out of severe drought in 2011 and 12, where we've been in extreme or exceptional drought conditions. This is just for the month of March, comparing other past Marches. It's not consecutive. It's only looking at the month of March. But that's a significant amount of the cow herd that is in pretty dry conditions, folks. And so we look at the cull rate as well. We've got one of the highest cull rates, the highest cull rate that we've seen in our data set. This only goes back to 1990. So it doesn't necessarily mean voluntarily culling cows. It means forced liquidation that we hate to see. Beef cow slaughter is just big. It's been extremely big since the last cycle peak in 2019, where we've continued to liquidate more and more females. Look at the heifers as a percent of U.S. feeder cattle sales. They're not being kept back as replacements. We look at the heifers as a percent of the cattle on feed, record high that we've seen since the early part of this new millennium. Drought causes this. Drought caused that started 2010, 11, 12. Those of you down here remember 2011. All those cows moved north, a lot of them did, and then the drought hit the north in 2012, and that's when we really liquidated the cow herd to a low in 2014. Remember what prices did, though, folks, and you hate to say this, and you do all you can do to hang on to the cow herd because you don't get to participate in these higher prices unless you have something to sell. We all know this, but this is kind of the same form that we're going towards down to when we liquidate the herd. We feel like that we're going forward to that into the 2024 time frame as well. Inflation's high. We know this, right? So I'm sitting here telling you numbers are going down and prices are going up, but are you going to gain any more net dollars? We've got really, really high prices, as we know, in terms of $100 crude oil, natural gas, exports to the EU due to the Russia-Ukraine conflict. Those exports are rampant today and probably going to continue going forward. So energy prices are high. We look at the consumer price index. One of these is the cause and effect of the other. You've all heard about this. You've heard that there's 8.6% consumer price inflation just during the month of March, the highest since December of 1981. Things are out of control. Inflation for the year we thought would moderate to the 3-4% area. I showed you a chart earlier that said the inflation's averaged just a little over 2% for many, many years. Now we're talking about 7% inflation for the year. That's not fun. But one of these causes and effect of the other, right? When you have disposable income that spikes, when you look at 2020, the government transfer payments, and I'm not saying people didn't need any help. I don't know. I'm not a politician. That's not my area. All I know is there's a lot of money that got sent out, and it caused disposable income. And disposable income is defined as income after taxes, money that you have to spend on whatever it is you need, rent, food, vehicles, fuel, those types of things. When it goes up, when disposable income goes up that high, you're going to have inflation. And when inflation goes up that high, you're going to have disposable income rates drop pretty hard. The thing that's encouraging on here is that U.S. real per capita disposable income is still higher today than it was pre-pandemic. We worry about demand destruction in the beef segment, don't we? We worry about pricing ourselves out of the market. That's a real concern going forward. It's a real concern. I'm not worried about beef demand from now through the end of summer, but if this continues and real disposable income starts to decline, we know that beef is the most price sensitive because it is the highest priced protein. I don't know what demand's going to do the second half of the year. We think it's going to be pretty good. It's been phenomenal up to this point. But this is something that we have to keep a very close eye on. So far, we're competitive. When you look at the price change since January of 2018, that's all we're looking at. Obviously, beef is the highest priced one. That's why it's the most price sensitive. Inflation and everything else. It's not just things that are impacting the beef market. This is impacting the farmers market as well. Look at these fertilizer prices: anhydrous, potash, urea. There's a lot of farmer feeders in the state of Iowa, in the corn belt that I speak to. The only reason they feed cattle is for the manure, for the fertilizer. You can see why in this environment, right? That is substantially impacting the number of acres that will be planted to corn because corn is a high input crop. The prospective planting report came out and said there would be 4 million fewer corn acres planted this year. We feel like the principal crop acres is really, really tough to get it to exceed 318 million acres in this country. We're going to get severely less corn acres planted. Of course, the prospective planting report survey was taken on, the last day was February 24th. Everybody remember what happened February 24th? That was a Russia-Ukraine invasion. So this could change, but we know we're dealing with $8 corn, a commodity. What does this mean to you as a cow-calf producer? It means your cattle are worth less because it costs more money to add weight to them, okay? This is something that isn't going to moderate very quickly. We don't know how many acres we're going to get planted here domestically. We also don't know what the situation is going to be in Ukraine. This is an interesting chart, and this is why Ukraine matters. Ukraine produces between 1 billion to 1.5 billion bushels of corn a year, and they export 80% of that. Again, we're in a drought here domestically. We're getting fewer corn acres planted, and we've got a situation like this where a country that exports 17% of the world's corn exports, they're getting shot at. They've got landmines in their fields. These farmers are having a difficult time going out there. Supposedly they're turning a lot of goats out to see if there's landmines, which, sorry for the goat, right? I mean, but that's not very fun to be out there on your tractor and be getting shot at either. This is why this matters. This is why this chart, that is, you can see kind of February 24th when that market really shot it. Corn market was going higher anyway. But when the Russia invaded Ukraine, it really shot up. And we're going to deal with these higher priced grains going forward. December corn futures up there around 7.5. You know, so far 4% of the corn. That was as of last week. Yesterday's number came out about 7%, but it's a slow planting progress. Weather conditions, particularly in the western corn belt, have been severe. They've had some blizzards. You've got some wet weather in the eastern corn belt and dry weather conditions and snow in the western corn belt. It's going to be big. You have nearly a 4 standard deviation move in corn momentum. Statistically speaking, that happens about every 126 years. So we know that corn prices are very elevated and will be going forward, but all feed prices are going to be high. All of them are going to remain high for you. Your input costs are going to be pretty tough until we get some drought relief. And it doesn't necessarily matter that it rains. A timing of rain and moisture is always welcome, but oftentimes it's too late to help this year, and you're always into next year as well. I know there's a lot of $250, $300 ton hay out there because I've purchased some of it. And that's something that's going to be very, very high going forward. And for those of you that are in a difficult situation of trying to hang on to your cow herd, it's going to be expensive. It just is. And unfortunately, we still want you to stabilize this cow herd because you're not going to like the replacement cost when it does start to rain. So do everything you can to try to hang on to them. That's the name of the game. Commercial beef production is lowering. This is indicative to higher prices going forward. We know that going forward that the commercial beef production will decline. It's still staying pretty high because we're killing a lot of cows. We've killed about 150,000 more beef cows year to date than we did last year. Export market's been good. It was up 17% last year. We're expecting it to be up about 5% this year, so moderating, increasing exports, but still very good going forward. This is something that I think is really, really important to you all, is the fact that the export value per head is worth nearly $450 per head. Look at this time frame from 1990 to about 2003. We saw we had kind of a level that we were in there from, say $125 to $175. Remember what happened in December 2003, the Christmas cow? That really hampered our exports due to BSE in 2004. We've climbed up. We went to a new and higher trading range between 300 and 350. We've just made the next notch up. These export values should stay at this 400 and higher level if we can get along with our trade partners. And that's very, very important. And these are where the exports are going. I think the noticeable one on here is China. That's very noticeable that we see that. We look at some of these others. South Korea has been a very, very good trade partner with us. Some of these are concerning because we have to look at this and say, well, some of these are maturing markets. Japan, for instance, for the last several years, it's pretty flat. When we look at Mexico, that's actually on a decline. The other countries are pretty sporadic. Canada, actually on a decline. Hong Kong, you would expect because it's kind of the back door through China. But Taiwan, some of these are maturing markets. We have to look at where can we send U.S. beef to other markets. I know the U.S. Meat Export Federation is working diligently on Africa because there's a growing middle income society there who can afford the product. And that's really what it comes down to. China's going to continue to be big, but they're pretty fickle traders, aren't they? We have to remember that China has a population, a middle-class population, that is larger than the entire population of the United States. They have 1.3 billion people. Surely they can get 350 million people that are middle class. They're getting a taste for U.S. beef. They like it. They want to continue to get it, but they're communists. They're pretty tough to count on them. Per capita net beef consumption declining. We see that as price supportive going forward as well. Moderating protein production of all types. This will be the 4th year in a row that pork and poultry production has actually declined. Again, this is price supportive going forward. If we can keep demand up, we look at the total exports of all 3 proteins. Again, beef up about 5, pork up about 2. Poultry up about 2 in terms of this year. And, we look at China, and we're behind on pork exports there. So apparently they've had another round of African swine fever, and they've been harvesting hogs pretty diligently there. But going forward, we feel like that the pork exports will come back, and obviously the beef export situation of that has been excellent up to this point. So we look at just overall poultry per capita red meat and poultry consumption declining. Again, price supportive to us here. When you take production minus exports plus imports, those types of things, we look at a smaller production and smaller per capita supplies. We look at this demand, we're worried about demand destruction. But when we look at this, so far beef has been able to keep pace and not outpace the other competing proteins because they've got record high prices as well. We also have to consider that beef has already largely seen its inflationary prices over the past several years. Beef inflation won't be as rampant as what normal consumer inflation will be because it's already occurred. We've got all fresh retail beef prices. They're at $7.36 per pound. But when you look at this on a percentage basis, particularly compared to like the boneless, skinless chicken breast, we're very competitive. We're not outpacing that, and that's something that we really need to watch because as disposable income potentially dries up, we are very price sensitive to demand destruction. This is getting into the bullish part of the outlook here. When we look at the live cattle strip, and the strip is simply the first 6 live cattle contracts that are average priced, okay? We call that the strip. You can see that for a long period of time, basically since late 2015, this market's been in a practical range of 105 to 125 based on the futures. We're exceeding that. We're bouncing through that. We're going higher. Can you net more dollars? Is the question. But these prices are going higher. We fully expected, and it was almost as if the rug got pulled out from under us. We had the bases loaded and the home run hitter was coming up to bat, and before he got to the plate, he kind of fell over this spring. We were fully expecting fed cattle prices to go to the upper 140s, low 150s this spring for a high. And Russia decided to invade Ukraine, and all the money left the markets, and it didn't happen. it was disappointing. The calf market was disappointing due to drought. The calf market, based on a 550-pound steer, could have easily been 230, 240 this spring, but due to the drought, it didn't occur. In the market was getting its tail kicked because all the money was leaving the markets. We're looking at the U.S. Fed steer price. These were some preliminary projections. I don't know if we're going to average 140. I think we still can. I still think we can have a range of 130 to 155 with the highs coming out there into the fourth quarter. Particularly when you look at the non-expansion years, the dotted purple line. You don't get as high in the spring time frame, but you tend to have a higher fourth quarter than you did during the first half of the year. I think this is we still feel like that this is still kind of the pattern of the market. It's probably a much flatter market. We don't see the seasonal lull in the market that we would see in the summer time frame. Maybe this market can be supported, and we fully think it will, somewhere in the low to mid 130s for summer lows. Some of it's an artificially inflated market. The Packer supported the market last summer for about 18 weeks in the mid 120s. Prior to last week, the Packer was supporting the market in the mid 130s. Are we going to continue to see Packer support? A lot of that has to do with Packer profitability. And something that nobody knows, I don't think, is when the Packer's only making $200 a head, do they cut the kill or do they kill more because it's more $200? We don't know the answer to that. They're going to extend the supply for as long as they can. Feeder cattle strip. This is the first 8 contracts because there's 8 on an annual basis. It's going higher as well. We feel like that all these prices are going to advance. We've been stuck or kind of capped at that 160 level on the feeder cattle index for a long, long time. We really expect it to continue to move higher. Cost of gains are obviously the biggest hindrance on this. But those of you that hopefully are able to run some feeder cattle out here, I don't know if that's going to be feasible for many of you this year. These prices are going to get better seasonally, but we still have to continue to watch what the corn values are doing, so that how it's impacting the cost of gain. We know the numbers are much tighter. As of April 1, we've got 700,000 fewer feeder cattle and calves outside of feed yards. Again, very price supportive going forward. We've got a lot of bullish news out there for you in terms of price going forward. 800-pound steers, again, the highest start to the year since 2016. I don't know that we're going to get to the 172 average just due to the price of corn that we have going forward. But you can see the seasonality of that market, the gray line on the 20-year index. You can see what prices typically do. They've been much flatter the past couple of years, but they have also moved higher. Still fully anticipate that. Most of the time what you'll see when you have these high costs of gains is that the deferred live cattle futures will move up to compensate for the higher corn costs. It lessens the burden on the feeder cattle market. Not completely, but it lessens the burden on the feeder cattle market because the deferred live cattle futures will move higher in conjunction with corn. There's a little bit of a lag, but they'll do that to compensate for the higher cost of gain, particularly as supplies continue to get tighter. For those of you that are in the hopefully bred female market, this is something that we've seen there's about a 90% correlation between the value of fed cattle and the price of bred females. In a drought, you're going to have not as good of a correlation. But when it starts to rain, you're probably going to have a correlation where bred females surpass the value of fed cattle. And that's probably what we're going to see. For those of you that can hang on, that can have some females to sell when it does start raining, you're going to be ahead of the game. You really, really are. Utility cow prices, this has been a really good market, especially considering the number of females that we've sent to market. And these guys can bring back $1,300, $1,400 per head on some of these cull cows this spring. That's been very, very good for them. Unfortunately, they've had to do that, had to sell them. We talk about 2014 and prices that we thought maybe we'd never see again the rest of our life. Our outlook to the market is that we will. Just follow the trends, not necessarily the specific price levels on each segment of this, but follow the trends of this. We're in the beginning stages, once again, of a higher cattle market. The 10 to 12-year cattle cycle is just starting to begin in terms of the price advancement. It's reason for excitement. I know it's hard to be excited when you have so little water and rainfall that we've had over the past 2 years, bulk of the past 2 years. It's hard to be excited. Get a little more excited about this because I think better times are coming your way. We've just got to hang on and weather the storm. As is always said, tough times don't last, but tough people do. And it's kind of one of those things to how do we look at this? Do we look at this as the glass half full or the glass half empty? You can look at it as, well, every day that goes by is a day closer to a rain, or you can look at it as, well, it's also another day that we haven't had any rain. Let's look at it from a glass half full standpoint, and better times are ahead for you. I hope that was a somewhat encouraging outlook for you because I think there really, really is hope for you to be encouraged about this market. I'm very proud of all of you for attending. I know Andy does a great job for you, and he continues to be one of my all-time good friends that I very much respect. And thank you for your attentiveness to me. If we can help you, as Donald pointed out, we'd love to help you at CattleFax. We're there for you for all types of producers of all sizes. We'd love to be able to help you out if this is some of the information that you find useful. Thank you all very much.
So we have time for a couple of questions for Troy. If you've got a question, raise your hand. We'll pass the microphone down to you. I know Joe Van Zant's probably got a question. Okay, here's Congressman Jackson.
Thank you. I enjoyed that. I got a quick question for you, though. I just got back, as you may or may not know, I just went on a congressional delegation with some members of the Senate. We went to Australia, Taiwan, Japan, and the reason we were there, the big focus of it was, Chinese aggression around the world, in particular what's going on in Taiwan. I'm a firm believer, being on Foreign Affairs and on the Armed Services Committee, there's going to come a time in the near future here in the next year or two where Taiwan's going to become victim to Chinese aggression in the same way that Ukraine is being attacked by Russia. And when that happens, the one thing that I've been talking to folks about is I think that there's going to be all kinds of sanctions on China, like we're trying to do to Russia right now. And you saw there that two of the emerging markets that are growing the most are Taiwan and China. I think those markets are going to take a huge hit. So my question to you is, what can we do? As legislators, how do we go about? I mean, we're looking at foreign trade agreements with different countries right now. The Biden administration doesn't want to do any foreign trade agreements with any countries. It was a campaign promise that he made to some extent. They wouldn't do that. But we're pushing right now in the House and the Senate to get foreign trade agreements. Where do you see the markets? If we have to find alternative markets, which I think we should be doing now, assuming that things in China and Taiwan might not be as good in the next few years, where would those markets be? Do you know?
Yeah, it's a great question. And as I mentioned earlier, we do have to look for new and emerging markets because just exactly what you pointed out. We don't know what the future holds there. The U.S. Meat Export Federation is working in Africa, certainly working tremendous efforts out there because they are emerging economies. The consumers are able to afford the product. That is the number one area, I guess, that I know of that the Meat Export Federation and in terms of growing beef and protein exports in general, we have to think about the competing proteins as well because if we're not exported, we have to consume them here. So we're worried about all the protein exports, but Africa is the place where we're seeing the most progress being made. But excellent question because you make some very good points.
Troy, I've got a question. Oh, Kelly Giles from Canyon, Texas. It's twofold. We've got a lot of feedlot capacity, limited amount of kill capacity. and it seems like we just never can get through the front end supply and work down. So if you'd address, you know, what does it take to make that happen? And the other one would go along with what Representative Jackson was talking about a little bit, is that due to the market situation, I'm not blaming the packer, but obviously they've got a monopoly situation. I mean, it's the effect. It may not be monopoly or technically in violation of antitrust, Sherman antitrust, but it sure has the same effect as monopoly. So going forward, you know, and it's not the only industry that's like that. The processors in lots of industries in the current situation have monopoly market effect. So can you address those two, how we're going to work out of both of those?
Yeah, they're hot topics, very hot topics, and monopoly, oligopoly, whatever you want to call it, they've got a stranglehold on the market. It seems like, and we can't do it without them. That's the bottom line, is we've got to have them, and they know that. I think we're going to get more competition. We're going to get smaller processors that are around the country that will ease the burden on that to a degree. Simply just where we are in the cattle cycle is going to ease that burden. And you referenced the front end supply that we have, that we continue to see just massive carryover of cattle, higher carcass weights. And part of that is because the packer is encouraging that we feed some of these cattle longer, particularly in higher cost of gains like we're seeing right now. You would assume that cattle would come to town quicker rather than later. But with the various grids and formula premiums that we've seen, there's some of these packers that have increased the thresholds on the number of yield grade 4s that are acceptable, the thresholds on the number of heavy carcass weights that are acceptable as well. And so they're doing that because they want the higher quality product. They want the choice and prime product because it's worth so much to them. Demand has been so good for that type of product that they can afford to pay more for it. The front end supply, we've got record cattle on feed numbers right now. The cattle on feed report came out last week, highest cattle on feed numbers that we've seen in history. Part of that's due to forced placements, due to the drought. Part of that is due to the market just simply not being as current on the fed cattle marketing side. But I would tell you that we're as current now as we've been in the past 2-3 years in terms of fed cattle marketing. And when I say currentness, is that cattle aren't carried over. We're selling them on a timely basis. We're not carrying them over as much or as often. And we're as current today as we've been. Again, the remedy to that situation is simply smaller numbers going forward. It's in the packers' best interest to extend the supply for as long as they can. They know that the leverage component of the market is going to come back towards the producer. They know this is coming. It's in their best interest to extend the supply. They'll do it for as long as they can. But at the same time, we still have record high beef demand that is going to push them to harvest the cattle on a more timely manner going forward. And that's really what we see going forward. There's not a simple solution for it in the near term, but we do see just the tightening supply that will be the remedy to the situation, not only for leverage, but also for price.
Troy, one more question, and introduce yourself.
Okay. Chris McClure, also from Canyon. This goes both to Troy and to the congressman. With the potential sanctions against China, as well as a target of Africa for an expanding market, what about the concern of China's growing influence throughout the African continent and their attempt to control the resources in that area?
Thanks. Yeah. I learned 2 things. Never discuss politics and religion.
Well, that's a huge problem. The Chinese have what's called the Belts and Road Program, if you've known for a long time. So they've been going all over the entire world and financing these projects. They'll go into a country that doesn't have a lot of money. All of these countries in Africa are prime examples. In Southeast Asia, they'll build bridges, they'll build roads for them, they'll build schools, hospitals, and they do it, they finance it when they do it, knowing that these countries don't have the ability to pay back, ultimately, the debt that they're going to owe. And when they default on their debt, then the Chinese roll in and they say, well, you defaulted on the debt, therefore this belongs to us, or in exchange, we want you to, to cut out the Americans in this particular market and start, buying from China for this particular issue, or we want you to allow us to keep our warships here and have a port, things of that nature. So the Chinese, their aggressive influence, either malign influence around the world, is a huge problem for us from a national security standpoint, but also from a food security standpoint and from from an economic standpoint, what's going to happen. So I think that the one thing we'll have to do is, if China ends up aggressively going after Taiwan, in addition to sanctioning China, which is not going to be good for a lot of us, right? And we're going to lose all of our chip manufacturing too, by the way. 90% of all the high-end chips in the entire world come from Taiwan, so we're probably going to lose that. We're going to lose our export market for cattle and some other stuff to some extent. We need to get these foreign trade agreements in place with these countries so that we can rely on that. And then we're going to have to hold their feet to the fire, and they're going to have to also push back against China. And I think if it's the Americans, the Australians, all the people that are in Japan, all the people that are in that area of the world, if we're all united on going against China, some of those other countries that they're beginning to essentially own at this particular point are going to have to fall in with us, and hopefully we're going to be able to take advantage of that and make markets out of these. But you're right, it's a big problem right now. China understands that when push comes to shove, the more people that they have in their pocket, the better. And so we're in a constant process in Congress right now to figure out how to undo that Chinese influence around the world, because it is going to come back to haunt us.